Dr. Patricia Hensley spent 31 years as a cardiac surgeon, earning between $400,000 and $600,000 a year for most of her career. She was, by any professional measure, exceptionally intelligent. She'd spent a decade in training before she ever operated on a patient independently. She could read an EKG in seconds and make life or death decisions under pressure without hesitation. At 62, facing a retirement she'd assumed would be effortless given her income, Patricia sat down with an advisor and discovered her investment accounts held $890,000. After a 31-year career averaging over $450,000 annually, she had less saved than she expected a mid-career engineer to have. Down the hall from the hospital where Patricia worked, a woman named Diane taught 8th grade math at the local public school for 34 years. Diane's salary peaked at $71,000. She retired at 61 with $1.6 million in her retirement accounts, nearly double what the surgeon earning 6 times her salary had accumulated. This isn't an isolated anecdote, it's a pattern well documented across financial advisory firms who work specifically with high-income medical professionals. Doctors, on average, are frequently among the worst-performing investor demographics relative to their income, while teachers, nurses, and other modest-income, high financial literacy professionals consistently outperform far wealthier peers. The gap isn't explained by intelligence. Patricia was almost certainly smarter, in the conventional sense, than Diane. The gap is explained by a set of very specific, very predictable behavioral traps that high-earning, highly credentialed professionals fall into far more often than modest earners do, and understanding exactly why reveals something important about investing that has nothing to do with intelligence at all. The first trap is what financial researchers sometimes call domain transfer overconfidence. It's the assumption that expertise and analytical skill in one demanding field should transfer naturally to an unrelated field like investing. Surgeons, engineers, and attorneys spend their careers being rewarded for confidence, decisiveness, and trusting their own analysis over conventional wisdom. That instinct serves them extraordinarily well in an operating room. It serves them very poorly in a market where confidence and analytical horsepower provide almost no advantage, because the market already prices in publicly available information faster than any individual, however intelligent, can react to it. Patricia, it turned out, had spent years picking individual stocks based on her own research, convinced that her analytical rigor gave her an edge over amateur investors. Financial industry data on self-directed high-income professional investors consistently shows underperformance relative to simple index strategies, driven almost entirely by excessive confidence in stock-picking ability that intelligence alone does not actually confer. Diane, by contrast, never once believed she had any special insight into which companies would outperform. She invested in a simple target date index fund inside her teacher's pension system and never touched it. Her lack of confidence in her own market-picking ability was, ironically, her single greatest financial advantage. The second trap is time scarcity, and it explains why so many high-income professionals end up outsourcing their financial decisions to the wrong people. A surgeon working 60 to 70 hours a week has almost no bandwidth to evaluate a financial advisor's incentives, understand a fee structure buried in fine print, or question whether a recommended product actually serves her interests. This time scarcity makes high-income professionals unusually attractive targets for financial products carrying high commissions, structured notes, whole life insurance policies marketed as investments, and actively managed funds with fees exceeding 1.5% annually, all pitched by advisors who profit specifically from complexity and inattention. Patricia had been in a whole life insurance policy for 22 years, sold to her by an advisor referred through her hospital, believing it functioned as both insurance and an investment vehicle. Over those 22 years, the policy's underlying returns, after fees and insurance costs, badly trailed what a simple low-cost index fund would have produced. Diane, meanwhile, never had the income to attract this kind of specialized sales attention. She defaulted to the simplest option available in her pension system, and that simplicity, forced on her by circumstance, protected her from a trap her wealthier colleague walked directly into. The third trap is fee blindness created by income cushioning. When you earn $450,000 a year, a 1.5% annual advisory fee on a growing portfolio doesn't create the same visceral discomfort it would for someone earning $71,000. The dollars involved are objectively larger, but the pain feels smaller because the fee is a rounding error relative to take-home income. This is precisely why fee blindness disproportionately affects high earners. A 1.5% fee doesn't feel expensive when your paycheck absorbs it painlessly every month. It is, mathematically, catastrophically expensive over a multi-decade career. On an $800,000 portfolio held for 20 years, the difference between a 1.5% annual fee and a 0.1% low-cost index fund fee is not a rounding error. It's typically $300,000 to $400,000 in lost compounding over that period, invisible the entire time because it never appears as a single charge, only as slightly lower growth, year after year, that nobody bothers to interrogate. Patricia had paid an advisor 1.4% annually for over 2 decades without ever calculating what that fee actually cost her in absolute terms. Diane's pension system charged administrative fees below 0.2%, not because Diane had negotiated skillfully, but because teacher pension systems are typically structured with low-cost options by default, protecting participants from exactly the fee erosion that quietly consumed a meaningful share of Patricia's higher income. The fourth trap is ego resistance to simplicity, and this might be the most psychologically difficult one to overcome for successful professionals specifically. Telling a surgeon that the optimal investment strategy is a boring index fund she never has to think about again is, in a strange way, an insult to a lifetime of being rewarded for expertise, effort, and sophisticated judgment. It feels beneath someone who has spent decades mastering an extraordinarily difficult skill to simply buy the market average and do nothing else. This resistance leads many high-earning professionals toward complexity for its own sake. Alternative investments, private placements, concentrated bets on companies they feel they understand professionally, precisely because simplicity feels unearned. Diane never experienced this resistance because nobody ever told her simplicity was beneath her. She had no professional ego invested in her portfolio strategy. Buying the simplest available option and leaving it alone for 3 decades wasn't a compromise for her. It was simply the obvious choice, uncomplicated by any need to prove her own sophistication through her investment choices. The fifth trap involves irregular attention driven by demanding careers, which paradoxically creates worse timing decisions than no attention at all. Diane's contributions happened automatically through payroll deduction every single month for 34 years, regardless of what the market was doing, regardless of news headlines, regardless of her own mood about the economy that week. Patricia's contributions and adjustments happened in bursts, often triggered by a rare free evening when market news had caught her attention, frequently coinciding with periods of either excessive optimism or genuine alarm. Research on investor behavior consistently shows that irregular, emotionally triggered investment decisions underperform automatic, indifferent, scheduled ones, precisely because the moment someone finds time to pay attention to their portfolio are disproportionately likely to be moments of unusual market emotion, exactly when decision-making is at its least reliable. What makes Patricia and Diane's story so uncomfortable and so important is that it directly contradicts the assumption most people carry about who should be good at building wealth. We assume expertise transfers. We assume higher income naturally produces higher net worth. We assume the people with the most impressive credentials must also be making the most sophisticated financial decisions. The evidence, across thousands of similar comparisons documented by advisors who specifically work with medical professionals, points in the opposite direction with striking consistency. The traits that make someone an excellent surgeon, confidence, decisiveness, a belief in the value of expertise and effort, are frequently the exact traits that produce poor investing outcomes. And the traits that made Diane's investing boring and unremarkable, low confidence in her own market judgment, no access to sophisticated products, automatic and emotionless contributions, were precisely the traits that protected her wealth for over 3 decades. Patricia eventually did recover some ground. In her final 5 years before retirement, she liquidated the whole life policy, moved her remaining investments into low-cost index funds, and stopped picking individual stocks. Those 5 years alone added meaningfully to her final balance, not because 5 years is a long time, but because removing the fee drag and the trading impulse immediately stopped the two forces that had quietly eroded decades of an exceptional income. If there's a single lesson in Patricia and Diane's story, it's that investing success has almost nothing to do with how smart you are in your professional life, and almost everything to do with whether you can resist applying that intelligence where it doesn't actually help. The market doesn't reward analytical brilliance, decisive confidence, or professional sophistication. It rewards patience, low costs, and the discipline to stop interfering with a process that works better the less it's touched. Diane never tried to outsmart the market because it never occurred to her that she could. That single absence of confidence, entirely unintentional, was worth nearly double the retirement account of a woman who earned 6 times her salary for 3 decades. The difference was never intelligence. The difference was behavior. Small financial decisions repeated for decades create enormous differences. The wealthiest habits are often the least exciting ones. They don't look impressive from the outside, but they quietly compound in the background. Patricia learned that intelligence can help you earn money, but discipline determines whether you keep it. Diane proved that ordinary choices, repeated consistently, can outperform extraordinary income. The lesson from Patricia and Diane is not that one profession is better than another. It is that the rules of building wealth apply equally to everyone. Income creates opportunity, but habits create outcomes. A larger paycheck cannot compensate for poor financial behavior forever. And a modest paycheck combined with excellent habits can create surprising results. The market does not know your job title, your education level, or your professional achievements. It only responds to your decisions, your costs, and your behavior over time. The smartest financial move is often knowing when not to act. Patience, simplicity, and consistency are not signs of a lack of sophistication. They are often the exact qualities that create lasting wealth.